Good afternoon, everybody. Thank you so much for joining our budget speech seminar and webinar. We really appreciate your attendance because we know that there's a number of seminars and webinars that's being presented, and we really appreciate you attending this one. It's been quite an interesting budget speech and related documentation. Somebody asked me this afternoon whether there are any bombs inside. Yeah, I think there may be a few. The question is whether it's a nuclear bomb or otherwise, but we'll see. If you look at our speakers today, we've got Annabel Bishop from Investec. We've got Gerhard Badenhorst, our VAT expert internally, and then myself, Emil Brincker. I'll start off with the one reference, and good afternoon. There's something in the Truman Show, a movie, that I want to explain until the very end, so you have to listen until the very end, until such time as I then explain the relevance of this afternoon. But over to you, Annabel. We can't wait.
Sure, thank you so very much, and thank you to audience for coming to listen. And I just want to say right at the start, if there are any questions that you have, please pop them into the conversation box so that obviously I can then look at them as I go through my presentation, hopefully answer the ones. I won't be answering any on tax specifically, but if it has an economic slant, then I'll obviously have a look at that. But I think quite key to note is that this budget this year, I think, has actually proved to be quite a bit better than the financial markets expected, and certainly many commentators expected as well. And I think one of the indications of that certainly is the fact that we actually see the currency moving to 14.40 today, yes, but also some improvement in the yield curve, and that's on the back of the lower borrowings. And I'm hoping that comes up in a minute. Yes, here's the message now, so I can talk you through the figures. So the lower borrowing trajectory actually drops from the quite scary 95% of GDP that was expected in the medium-term budget policy statement, was the mini budget update that occurred in October last year. If we have a look then, it was for the year 2025-26, so a very high number, particularly if you bring in the contingent liabilities of government, you know, the state guaranteed debt. And what that really means is that government putting guarantees over the issuance of state debt brings total country debt over 100%. And that's a big worry for South Africa. Now, it's dropped down to about 90% instead of 95%, or to be very precise, 89% for that 25-26, the peaking of our planned borrowing trajectory. And this obviously still takes us close to 100, but not over 100 if we include this SOE debt. The reason this is so important is that this really gives us a good summation of what the credit rating agencies are expected to make of this budget. And we think they probably won't downgrade us in the first half of this year. So we're finding ourselves in a situation where Fitch and Moody's both have us on a negative outlook. Now, Fitch is the worry because Fitch has us on double B minus, and that's quite scary because a short while ago we're actually on triple B minus, but nevertheless we could fall into the single B categories. Now, after the single B categories comes the C grades, and then I'm sure, as you would expect, D for default. So South Africa doesn't want to go into a debt default. We certainly don't want to fall into a downward debt spiral, and that essentially result in a bankrupt state. This type of collapsed state, such as Zimbabwe, Ecuador, Argentina, is just very, very detrimental for the vast majority of the population, as we know. So hence the jubilation in financial markets, the improvements in the rand and the bond markets. Of course, from a currency perspective, indications that we probably will be issuing a little bit less is also quite positive, because that obviously then makes investors' appetite increase a bit. It increases the likelihood of the repayment of the debt. And that's what the credit rating agencies look at. They look at the creditworthiness of South Africa's government debt. So what that really means is how likely in the credit rating agencies' metrics, because they do perform a huge amount of work to assess this likelihood of repayment. It's not something that's done lightly. How likely is a sovereign to repay its debt? And one of the key areas that determine this is very much the supply of debt. And of course, when you reduce your supply, it then makes it more likely. But if we have a look, where is South Africa placed? Well, South Africa as an emerging market middle income economy is actually sitting at 80% of gross debt as a percentage of GDP, and the norm last year, remember these figures I'm giving you are for the bulk of last year, so 2020-21, the fiscal year ending in March 21. So for middle income emerging market economies, their debt last year was sitting at 63%, and that's a worry because, as you can see, we are exceeding it quite substantially, and that is why we have a worse credit rating than most of them, and also why we're at risk of a credit rating downgrade. Secondly, of course, if you look at our fiscal deficit. That's the difference between our expenditure and our revenue. So fiscal deficit, again, not very good for South Africa, 14% last year, the mismatch gain of GDP. And if you have a look at the average of these emerging market middle income economies, of which we are one, their average is sitting at closer to 10%. So South Africa exceeding its peers, and of course still at risk of credit rating downgrades. And here we would say, if we do manage to reach those projections that we are looking at. So the credit rating agencies do rate us on where we are today, but they also rate us on our economic growth and of course the prospects for economic growth, because that in turn informs revenue collection. Revenue collection, very, very important for South Africa, because obviously we saw a big chunk taken out last year from the COVID crisis, but particularly over the past decade, we have not seen revenue keep up with expenditure. And expenditure has grown phenomenally over the 2010s decade, often known as the lost decade. Economic growth has declined from over 3.3% to about 0.5%, precisely 0.2% in 2019. And that downward trajectory is actually a structural decline. Indeed, we fell into a structural recession at the end of 2019, the second half, and into 2020. In a way, we were actually rescued by the COVID-19 collapse of the economy, because then we could essentially blame it on COVID-19 and not on the structural downturn. You know, the recovery that we're going to see from an economic perspective now going forwards into 2021, certainly, but certainly further out as well, is going to be slow. There's deep scarring of the economy, and the IMF certainly has coined that phrase, both globally and internationally as well. In fact, National Treasury, but also many economists at large, believe that South Africa will only recover to its levels of production it experienced at the end of 2019 by 2024. Now, that's a very long haul. And that indicates to you that revenue collections for the current fiscal year probably were a lot lower than the one before. And of course, they were. You know, in the 2019-20 fiscal year, and again, remember the bulk of the year falls in the 2019 period, revenue collections were at about 1.5 trillion. Now we're finding ourselves certainly around about 1.3 trillion, but luckily we actually had a revenue overrun. So government actually estimated that revenue would come in at a lower level this year than it actually is likely to do so. So now they're estimating it at 1.36 trillion, close to 1.4 trillion. And that, of course, gives us this revenue overrun of about 99.6 billion rand. And they're going to be utilizing that to pay, yes, certainly for the vaccine rollout, which is going to be free for South Africans, but also, of course, as well to use it, as we heard earlier, to reduce the borrowing trajectory for South Africa, rolling us off a lower base from next year, reducing our bond issuance, which could fall from over 6 billion to below 5 billion a week. And of course, this type of environment, again, as I said, very positive for financial markets, but more importantly, to have a focus on other areas as well, perhaps not more importantly, but also important to have a focus on other areas as well, and that it actually underscores the sustainability of government finances going forwards. And, you know, the reality of the situation is that with so many people in South Africa unemployed, and of course, with so many South Africans falling out of the formal employment net in particular, the imperative is to be able to maintain our social welfare expenditure, because that then helps these individuals to lift themselves out of poverty through government's basic services, which include health, yes, but also, of course, as well, education and free basic services such as electricity, water, sanitation, a number of other areas, which again help individuals to pull themselves out of poverty with government's assistance. Government's also extending the COVID grants as well. The TERS has also been extended somewhat, and all of these are helpful to South Africa's economic recovery. But the bottom line, you know, where I really want to get to is that South Africa still has an enormous debt trajectory. We still are, as we know, well above our peers. South Africa needs to generate substantially faster and stronger economic growth in order to cope with such a very high debt trajectory, to be able to service the debt and, of course, to meet its expenditure obligations. Now, you know, quite important is that government is looking to consolidate its non-interest expenditure in real terms. And that is quite key. What that really means is non-interest expenditure is expenditure that you are not spending on paying for your debt. So you can imagine having such a huge quantity of debt. South Africa also has very high interest payments. And in fact, these absorb about 20% of revenue. So not a good environment that we sit in. Now, government is looking to consolidate expenditure that it can control, because we can't obviously control our interest payments. We have to make those. And they're looking for it to decline in real terms by 0.8%. And that is extremely good. You know, from that perspective, it means that we actually are again, as I said earlier, on path to consolidate our finances. In fact, the bulk of this consolidation comes through reducing civil servant salaries and wages. If you take out the civil servants compensation, you actually see some real non-interest expenditure growing by 0.4%, and that's directed towards the economy. So a little bit of technical information there for those who like figures, but I think it's really, really important to note that we are on the fiscal consolidation path. So to our budget deficit, which is, as I said earlier, looking at coming out at 14% for last year, dropping down to 6.3% at the end of the medium-term expenditure framework, and that's 2023-24. So again, very, very key point here. I'm just opening a figure, a graph so I can get some more figures for you. But I think, what's quite key here is that we are finding ourselves in a situation, yes, where this fiscal consolidation is also going to see our primary deficit drop towards 0% over again this medium-term expenditure framework period again, 2023-24. And, the very important point about that is that we will then stop borrowing to fund current expenditure. Current expenditure is money we spend on civil servant salaries and wages. That's the vast amount of money, as well as on interest payments for debt, as we discussed, and of course some of them are, of course, on goods and services. So, no one who runs a sustainable household believes that borrowing endlessly to pay off your interest on your credit cards and obvious or other debt, and of course also borrowing to pay for current expenditure is sustainable. You need to borrow obviously to spend on fixed investment, and as a consequence of that, cutting out current expenditure, dropping it down to 0%, that's what the primary deficit tells you, that this collapse in the primary deficit means that government is looking again, as we said earlier, to consolidate its finances. So I think I've spoken for quite a lot. I don't see any questions coming through yet. I do encourage you to type them into the Q&A live event section. There's these little squares with a question mark in them. So if any of you would actually like to put any questions, please do so. I know I've spoken for a while. I think I'll just summarize and end off now. And then if there aren't any questions, I'm probably going to have to leave at 5:30. So this is probably your last chance. In summary, I would really say about the budget again, that it's a good budget. It's not enough to avoid further credit rating downgrades if we don't see the consolidation that we're looking at. In fact, if we don't see even a better budget than we are projecting now, it's enough to probably avoid them for the first half of this year. The credit rating agencies Standard & Poor's and Moody's are looking to rate us in May for their country review, which is quite a lot later. Normally it's in March. And of course, the situation that we are finding ourselves in with the credit ratings being on a negative outlook is that they actually do have to downgrade you. And if they don't, then they have to return us a stable outlook. So if they don't downgrade us in the first half of this year, they'll have to do it in the second half of this year, around about November. But then as a consequence, I see there's a flood of questions coming in now, but then as a consequence of that, obviously, if they don't, we'll have to return to a stable outlook. Okay, so it says, how realistic is the cut in salary cost actually happening? So there was quite a nice point from government on it. I don't know if I'll be able to find it. I'm going to quickly try and scroll it. They just wrote it so nicely. They basically said, oh, here we go. In December 2020, following government's decision to not implement a wage increase in this 2021 year, the Labour Court appeal reaffirmed the National Treasury's constitutional role in safeguarding the finances. In this regard, and that's the Constitutional Court, the approach to future wage negotiations will align with the fiscal position and prevailing economic conditions. This is the judgment. And the 2021 budget proposes significant moderation in spending in the consolidated wage. So it seems as though government now has the support of the courts in implementing these salary costs. So it does seem as if they're quite likely to happen, unless, of course, we get a change in the judiciary's view. 2021, 22 and 23 real GDP growth is forecast to be 3.3, 3.2 and 1.6. Yes, that's my worry as well. Is this enough? So definitely not. And I think we were talking about this earlier. For our 2021 forecast this year, we have got 2.9, so it's very close to around 3%. For the 22, we've got 1.9, which is close to 2.2, and obviously even for the 23, similar to that. So that shows a declining trend. Now, why do we have this big jump up in 3.3? Well, last year we had a big collapse in the in GDP, contracting by 7.3. As a consequence of that, we found ourselves in a situation where, from a statistical base effect, we're going to get a big jump up in this year. But of course, we're now finding ourselves that without the structural reforms coming through, that is the weak growth trajectory, and that's not enough. So we certainly need to see quickening of structural reforms. Another question, how would the deficit look if we assume that public wages continue to grow at the inflation rate and government can't bring down the public wage bill in real terms, well, what would be a disaster? It would be worse than what we had last year, probably. Anything done to tackle unemployment? Look, I think it's quite key that we're finding ourselves in a situation where we actually are looking at corporate tax cuts. That's very exciting. From a 2023 perspective, so next year, and from April next year, and essentially that then is very positive to reduce unemployment and obviously stimulate economic growth in the economy. But yes, government's put in a lot of measures to help with the unemployment perspective as well. I'm going to have to leave soon, but I would encourage anyone who's on the seminar, if you want to receive the research I put out, because I'm writing a piece on this budget review right as we speak, and that obviously will answer a lot of these questions, then you're very welcome to send me an email, and you can get it from this conference that you're attending. I'm sure they'll send you my email address if you ask them to. And unfortunately, that's all I really have time for. But thank you very, very much, and I'm sorry I have to leave now to go to a media interview. Over to you, Gerhard.
Thank you, Annabel. Thank you so much for sharing your views on the budget proposals on the economy, and also for your time this evening. We appreciate it very much. Thank you.
Pleasure. Bye-bye.
Bye-bye. Well, from a VAT perspective, there's really not a lot, which is not necessarily a bad thing. If we look at the revenue collections, firstly, we're considering that there is an expectation of about 325 billion rand to be collected from VAT for this fiscal year, which is about 24 billion rand less than last year. But what is interesting is that the percentage of VAT collections as a percentage of total revenue collections has gone up quite a bit. It's just under 27%, and that's the highest percentage of total tax collections that it has been for a very long time, and I think it's the highest percentage ever, quite a bit up from just under 26% last year. There's not been any VAT rate increase as we all expected, and as I'm sure you know by now. There's been a couple of proposals in the budget review as far as VAT is concerned, for those of you that are interested. There's been quite a big concern of SARS now for the last couple of years with regard to the gold industry, and particularly the claiming of VAT refunds in the supply chain or the value chain with regard to the gold refining industry, particularly in the exportation of gold. And they said that they're going to publish regulations to counter these malpractices. And I think we will probably only see how it will operate once the regulations are published. There's a new product, superfine maize meal, which will be added to the list of zero-rated food items. And then a long-standing issue with regard to property developers. This is property developers of residential properties. As far back as 11 years ago, the Minister of Finance at that point in time already indicated that certain relief measures will be introduced, and the value on which property developers, where they develop residential properties for sale, and which they temporarily let those properties, the value at which those letting will be taxed. We've seen some relief measures. Those relief measures were all taken away at the end of December 2017, beginning January 2018. So we're back there again. So hopefully we'll see proper relief measures this time around. And then lastly, just as far as insurance is concerned, the insurance or the VAT legislation will be aligned to the Insurance Act to cater also for micro insurers as provided for in the Insurance Act. Well, seeing that there's very little issues and proposals as far as VAT is concerned, I thought I'll use the time just to share with you some insights of two recent court cases involving VAT, which are quite important and which have quite wide implications. The first one is the case of Consul Glass versus the Commissioner. That was a Supreme Court of Appeal judgment recently, and it involved the deduction of VAT on fees incurred in respect of loan funding that is acquired from local banks. And the purpose of that loan funding was to repay the euro bonds and to redeem those euro bonds. The issue here was that as far back as 2007, Consol Glass, the taxpayer in this case, was a shelf company which acquired the businesses, the glass container manufacturing businesses of 3 other entities at that point, and it funded the acquisition with the issue of euro bonds. But after a couple of years, the euro bonds became very expensive, and it became also a risk for the company because of the devaluation in the rand, the volatility of the rand, and also the high cost of hedging against the volatility in the rand. So they decided to approach a consortium of local banks to acquire loan funding in order to redeem those euro bonds and to replace it then with local funding. And the issue then is, of course, whether the VAT incurred on the fees that are paid in respect of the loan funding that is acquired, whether they qualify as input tax, and also the fees paid to the foreign service providers to redeem the euro bonds, whether that comprises imported services. Now, in this regard, the Council for SARS had, as a principal argument, both in the tax court as well as in the Supreme Court of Appeal, they argued that the acquisition of the loan funding comprised a debt security. And the issue of a debt security is an exempt supply. And because Consol is considered to make an exempt supply, it is precluded from claiming the input tax deductions. And it based this argument on a definition of a debt security which includes an obligation or liability to pay money. The alternative argument was that there is not a sufficient or close enough sufficient link between the acquisition of the loan funding and the making of taxable supplies. And in this regard, the court considered firstly the debt security argument of SARS, and they said that Consol Glass is registered for VAT purposes as a glass container manufacturer. It's carrying on a manufacturing business, that is its enterprise. And at no point in time did it change that business or the enterprise to a financial services enterprise. The next issue that they considered is that the acquisition of loan funding does not comprise a supply made by Consol Glass. It's actually the banks that made the supply, and that seems quite obvious. And then the other aspect was that the conventional loans, like the loans that were acquired by Consol Glass, the court said that it doesn't fit comfortably within the definition of a debt security. And on that basis, it dismissed that argument of SARS that when you acquire loans, it's the issue of a debt security, and therefore you can't claim your input tax deductions. And I just want to pause here and just make one observation, and that is that when you carry on an enterprise and you consider whether you need to register for VAT purposes, then if your taxable supplies, and that is any taxable supplies from any enterprise that you carry on, if it exceeds the registration threshold of a million rand for a 12-month period, then you have to register for VAT purposes. And once registered, you need to account for VAT on all your supplies, all taxable supplies, whether it's generated from a manufacturing enterprise or from a financial services enterprise. So although the court came, in my view, to the right conclusion that the acquiring of loans is not a debt security, it perhaps didn't get to the right answer in its arguments in terms of the operation of the VAT scheme. With regard to the second argument of SARS, or the alternative argument of SARS, and that is the link between the acquisition of the loan funding and the making of taxable supplies. Well, here the court went back to the original issue of the Eurobonds, and it said that at the time that Consol Glass acquired the businesses, it was a shelf company, it acquired the businesses as going concerns. So the businesses itself were not impacted at all because it acquired the businesses and it carried on those businesses as they were before, and the only thing that happened was a change in ownership. And then the other aspect that the court considered is that with regard to the issue of the Eurobonds, they said that the purpose of the issue of the Eurobonds was actually to effect a reorganization within the Consul Group. And the effect of that reorganization, yes, it was to acquire the taxable businesses of those three companies, but it was still to effect a reorganization. And on that basis, they said that the issue of the Eurobonds did not have a functional link with the taxable supplies being made by Consul, and on that basis, it disallowed the input tax deductions and confirmed the assessments on the imported services, because it said that the loans that were acquired from the banks fulfilled the same purpose. And again, just two observations. The first one is that if you acquire a business as a going concern, and particularly a shelf company, when you acquire that business, there is no impact on the business itself. But that is the essence of a going concern, is that the purchaser must be placed in a position that it can operate that business as it has been operated by the seller. And that, in effect, is a going concern. And particularly a shelf company as well. The shelf company did not carry on an enterprise before. It had to acquire this business in order to make taxable supplies. And then the other aspect is with regard to the look through to what happened in the broader Consul Group. The court said that there was a reorganization. Now, generally from a VAT scheme perspective, VAT is levied on a vendor in respect of the transactions of that vendor itself. And the nature of a supply is determined, or the VAT status thereof is determined by the supply made by that vendor. But here the court looked through that and said that we need to look at the broader group of Consul, and that is where reorganization took place. And the proceeds of the Eurobonds were to effect a reorganization. But that is applying group taxation, which is not catered for in our legislation. The implication of this judgment is widespread, and I think we can expect that for any entity that embarks on a debt restructuring, that SARS will seek to disallow the input tax deductions on the basis that there's no functional link between the funding that is acquired and the taxable supplies. But if you just think about it, any capital or debt structure is absolutely vital for any business. So you can't operate without that. And it's on that basis that Consul then approached the Constitutional Court with an application for leave to appeal against the judgment. Of course, as expected, SARS opposed the application, but the Court still needs to make a decision as to whether the appeal will be allowed or not. If they allow Consul to appeal, then that's perhaps not the end of the matter. But if the application for leave to appeal is refused, that of course is the end of the road, and we would have to apply the judgment as it stands at the moment. The next case that I want to deal with is the case of Rapper Resources versus the Commissioner. And this case dealt with the claiming or withholding rather of input tax deductions by SARS whilst it's conducting an audit. And the court was called upon to decide whether SARS was entitled to withhold refunds while it's carrying out an audit. In this case, Rapper, by the way, is also a refiner, gold refiner. And as I've mentioned earlier, we've seen in the budget proposals now that certain regulations will be introduced in order to counteract malpractices in that industry. But SARS carried out an audit for a long time, nearly a year, at Rapper Resources. It did not find any evidence of malpractice. But the audit resulted in VAT refunds of about 1.6 billion rand being withheld by SARS. Now, of course, that had a major impact on the business and also the ability of the company to continue its operations. So it approached the High Court on an urgent basis to compel SARS to finalize its audit and to pay the refunds. Now, SARS in this case relied on the provisions of the Tax Administration Act, which says that they don't need to authorize a VAT refund before an audit is being finalized. And they only compelled to authorize the VAT refund if security is provided which is acceptable to the Commissioner, security that is provided by the taxpayer, and then security needs to be provided for the total amount of the refund, otherwise no refund can be paid. Now, the High Court in this case firstly considered the issue of security and said that there's no basis for SARS to argue that a taxpayer must provide security for the total amount if the taxpayer is entitled or able to provide security for a portion of the refund due, then to that extent a refund must be paid. As far as the audit is concerned, SARS considered all the evidence and the representations of SARS's counsel and said and gave an order that SARS must complete its audit within a specified period and specified a date in the order, in a court order by which SARS needed to complete the audit. Now, in this whole saga as well, SARS also withheld refunds that were due to periods which were not subject to an audit. And in that case, the court said that there's no legal basis for SARS to withhold any refunds for a tax period which is not under audit. Now, this is a big win for the taxpayer, but unfortunately, the problems still continue because when SARS conducts an audit, then there's an automatic stop on all refunds, and that continues. So you would have to apply then or approach the High Court for relief for SARS to finalize the audit if they drag it out for a long time, as they have done in the Rapper case. But not everyone has got the means to approach the court. And even if they do so, it's quite often the circumstances do not warrant an urgent application to the court. And then it can take months and months before the court can hear the case. And with regard to the withholding of refunds for tax periods which are not under audit, that still happens. But if we then approach SARS and inform SARS that they're acting illegally, they simply just then issue a notice of audit for those particular tax periods. So what we have here is a real problem. And I think the only problem or the only way to solve this problem is legislative intervention, where the Tax Administration Act is amended to compel SARS to at least complete an audit within a particular period, or to compel SARS to pay VAT refunds whilst there is an audit under certain circumstances. But so that brings me to the end of my presentation, and I'm now going to hand over to Emil, who will deal with the broader tax issues. Thank you, Emil.
Thank you, Gerhard. I think what we should do is maybe just start with the way in which the Treasury has approached this whole issue. And the issue is really, to a large extent, is how did they go about in preparing the budget. So what I can do is maybe start with the hindsight and what has happened from a practical perspective. And then what I'll do is to start with the major issues and deal with the major issues as set out in the budget speech. So let's maybe look at what happened in hindsight. I think we saw what has happened. We had an increase in revenue projections, and then for 2021 we're about 10% down from what was collected in 2020. Very importantly, who's actually paying the tax? If you look at the bottom there, it's actually personal income tax, 39%. that's actually being paid. So the burden of tax rests on the individual and not really on any other entity. As Gerhard has indicated, we've got the increase of 26% in respect of that. But ultimately, you can just see the real burden lies upon the personal income taxpayer. Interestingly enough, what has happened and how did the trends change? Personal income tax changed from 36% to 39% in a number of years. That actually declined a bit from 2015-16 to 2019, and then you had the others. So you had the annual compound growth, but at this stage then we have the reduction. Cost of revenue collection actually reduced over the years, but as we saw this afternoon, the Minister indicated that an additional 3 billion rand will be allocated in order to implement certain projects, especially with reference to high net worth individuals. So we can see this 0.8% potentially increasing over the period. The active register, if you look at that, 22.9 million individuals registered for income tax purposes, 831 for VAT, trusts 363, and then from a company law perspective, 2.5 million. So that's more or less what we're looking at. Registered individuals, 22.2 million. So, but of the 22.2 million, only 6.3 submitted returns, and then 4.3 were assessed. So 68.8% of the taxpayers that submitted returns were in fact assessed. Now, as we also saw, we're a progressive community and society. So females contribute 45.8% and males contribute 54.2%. Very interesting, and I always include this aspect. There were 1.149 million taxpayers that had taxable income in excess of 500,000 rand, whereas there were 6,500 that earned in excess of 5 million rand. So that's where we're looking at, but potentially, and this new section and that's going to be introduced by SARS is going to be focusing on that 6,500 individuals that earned more than 5 million rand. Interesting also, if you look at those assessed, only 18.1% owed an amount to SARS and 68.3% then received refunds. And who's the contributor? It's actually Gauteng. 40.9% of the revenues are actually generated in Gauteng. Lastly, what were the tips? Let's see whether or not our Minister of Finance listened to the tips. No tax increase, half the staff in Parliament. No tax increases except for millionaires and politicians. And then invest in social workers. There will be an increased need for them as we look at the deaths and the COVID implications. So what happened? What are the budget highlights? Essentially, what one is looking at is there's a broadening of the tax base. So what's happening is that incentives are closed down, a number of specific avoidance provisions are closed down, and then at the same time, the intention is then to reduce the rates, because I think what has been appreciated is that one is looking at rates that are probably the highest or some of the highest in the world. If you look at, for instance, corporate tax rates, it will be reduced to 27%. Years of assessment commencing on or after 1 April 22, but the average rate is about 23.4% worldwide. So we're still on the higher end of the spectrum with reference to the corporate income tax rate, but it is at least a move in the right direction. Because once again, I need to stand to correction. I thought that the income tax rates will be increased. I thought that the capital gains tax rates will be increased, but none. In fact, what happened is that there's no bracket creep as well as what happened in the previous years, because the income tax brackets will be increased by 5%. But as I said, broadening the tax base, focus on transfer pricing, tax base erosion, and then all of you that are listening, be careful, because there's this dedicated unit that will focus on individuals with wealth and complex financial arrangements. And the first correspondence, just look at your emails and your letters. During April 2021, you may be expecting these letters pertaining to reconciliations, because what we've seen as well is there's been a number of letters that SARS wrote asking taxpayers to reconcile the information that they received from financial institutions compared to the financial information that the taxpayer submitted. And it's a very difficult issue because sometimes the information received by SARS is wrong, or otherwise the reconciliation is expected to take place over a period of 6 years. But that's really the approach that has been adopted by SARS now. So they ask you to reconcile the information that SARS received, also from CRS, that's from other countries. So it's not only limited to a South African context, they also now started to ask questions with reference to information that they received from other countries pertaining to the affairs of taxpayers. So we can see an increase, and we can expect an increase, in fact, in revenue collection and the broadening of the tax base. So what has happened? Yes, we may see a reduction in the income tax rate with reference to corporates and maybe even individuals. We're not going to see an increase in the rate pertaining to individuals, but we're going to see this broadening of the tax base. And I think that's really the general approach that's now been adopted, including with reference to the issue that incentives are gone. All incentives, airports, port assets, rolling stock, loans for residential units, all of them are gone. The only ones that will actually be extended relate to urban development zones and learnership tax. And the learnership tax will also now be investigated, as we'll see a bit later. So ultimately, we see a scenario where incentives are going to be abolished, and then we have the broadening of the tax base, hopefully with the reduction in the income tax rate at some stage. So I think one of the biggest issues and the casualties relate to the Section 12J venture capital company regime. And I think if there has ever been any lobbying, this was it, because about every person that invested in a venture capital company or VCC made presentations to SARS and National Treasury. But unfortunately, it was indicated that to a large extent, the type of investments, wealthy taxpayers, because they said that 1.7 billion rand was actually claimed by taxpayers that had a taxable income in excess of 1.5 million rand per year. And they also said that it did not really stimulate new employment. To a large extent, it's really existing employment that continued in the underlying company. So they've indicated that the section did not really meet the expectations, and on that basis, the sunset date of 30 June 2021 will then be enforced. Obviously, you can still invest before that date. The benefit is that you can deduct your full amount of the investment, and then if you hold it for 5 years, any proceeds will be on capital account as opposed to be on revenue account, even though the base cost of the investment at that stage will be zero. But the benefit is you can claim your initial investment as an income tax deduction, and then ultimately when you sell the shares in the venture capital company, the benefit is that you can get it on capital account. So it's quite beneficial to taxpayers, and that's why maybe we saw one or two VCCs that tried to maybe abuse the system, and I think to a large extent that may be also the reason why it was decided to enforce the sunset clause. It's a pity, because I think the intention behind that was quite good. It's really a question of whether or not it served its purpose. Then very important for all of us as well, because we're all properly sitting at home working, and the question is really to what extent can we claim travel allowances, because at this stage the view of SARS is if you travel from home to the office, you can't claim that as a deduction or allowance. And then also to the extent that you have a study, the study must be specifically equipped for purposes of your trade, and it must be regularly and exclusively used for such purpose. So if you sit like me in a dining room table, that's not going to work. Or alternatively, if your kids are playing PlayStation or whatever the case may be at your home study, that's also a problem. So that's really one of the key issues. One thing that one must appreciate is that even if you qualify to claim a home study allowance, that if you sell the house subsequently in 10 years' time, that portion of the house that's allocable to this home study will then not qualify for the CGT exemption and otherwise, because you actually used it for a different purpose. So the 2 million rand exemption and all those type of things. So you should be very careful before you think to claim the Home Office allowance because there are negative consequences associated with that as well. The one issue as well is to what extent can one claim rates, to what extent one can claim printing and other type of expenses, office expenses, telephone expenses, those type of things, and all those type of things will have to be clarified because there is unfortunately some uncertainty pertaining to what we can claim, but I think to the extent that they simplify that, there's going to be a significant claim in relation to the Home Office allowances, and SARS will have to take that into account because that may have a significant impact upon the ultimate allowances that are claimed at this stage. To a large extent, pension provident allowances and medical aid, medical benefit society credits and those type of things form the bulk of allowances, and I think Home Office allowances will then maybe slip in between and maybe get first, depending on the circumstances. Another important issue relates to the employment tax incentive. It's been very useful and it incentivized the training of employees, and once again the intention behind that can't be faulted. What has happened, unfortunately, is that employers have now entered into agreements with training institutions where the training institutions provide the training to the individuals or the employee. The employer just signs a contract. It never sees the employee, doesn't offer employment to the employee, and the employees and the individuals are really under the control of these training institutions. So it's not really employment in the strict legal sense of the word, because ultimately you just make a payment to the training institution for a fee, and at the same time you claim the ETI incentive. The only issue is that the fee is then determined to some extent with reference to the incentive that you can claim. So the training institution fee, so that ultimately you may break even or make a small profit. And we've had a number of instances where employers have actually more employees subject to the ETI incentive in their employment than the normal employment. So the question also arises, I think in the one case, they had about 500 normal employees and about 3,000 ETI employees. And the question really arises, is that true employment? And I think that's really what's going to be addressed potentially, that one is dealing with true employment. Hopefully it won't impact upon the training to individuals and employees, because South Africa needs training, South Africa needs employment, and even to the extent that you employ somebody for a year and he receives a salary, that would to a large extent then at least assist to curb the high unemployment rates that we have in South Africa. Another interesting thing that SARS has now picked up again, and I'm not sure how they do that, because I often think that they might be informants. But what has happened as well is that taxpayers then, let's say, enter into a contract or enter into an asset or buy an asset, let's say a house, before it's actually leased to a third party. And then they transfer that contract or the income stream or the use of the asset to the trust while they render the services. So they render the services, or the contract, the lease agreement is entered into subsequently by the trust, and at the time of the cession of the contract, or at the time the benefit is received by the trust, the argument is that the value is zero, because at that stage it's just a contract, no services have been rendered, or to the extent that it's just a property, nothing has happened, you still need to build the property, you still need to enter into the lease, those type of things. So as and when the services are rendered or the asset is used, you actually obtain the value. And it seems that SARS and National Treasury are going to look at this and then also maybe tax the value that is attributed over the period, instead of arguing and accepting the fact that at the time the contract is ceded, there is no value. So the value creation in the trust may in fact be curbed and addressed from that perspective. Then I see there's already been one question pertaining to retirement fund withdrawals and immigration. The bottom line is National Treasury and the government doesn't want you to immigrate. So they make it as difficult as possible for you to immigrate, especially to the extent that you have any retirement fund interests. We had the 3-year rule that we saw last year pertaining to the access, arguably on the basis that it sought to deal with the relaxation in exchange controls. clearly it didn't. The 3-year rule was never part of exchange control. So now what the suggestion is that you now deem to have withdrawn your interest from the day before immigration. So those of you that still think of immigration, do that quickly before maybe the 1st of March, if it's still possible, because the problem really is that you then seem to have withdrawn from the fund. There's a tax payable, and then if you leave the funds in the fund, then there may be a second tax when you withdraw it, but you'll get the credit with reference to whatever taxes you've paid whenever you deem to have withdrawn from the fund pursuant to your immigration. So I'm not sure how that system is going to work, because there's issues like the time value of money. The amounts may be different. To what extent are you taxed? Is the first in, first out type of scenario. But I think this will once again result in either high net worths not necessarily making investments in retirement funds, or alternatively carefully consider immigration, because it's going to be very difficult to the extent that you actually have to pay the taxes. Your amounts are, you don't actually even have the amounts, and then you get the credit whenever you receive the funds from the retirement fund. So it's going to be a very difficult scenario to the extent that you have retirement fund interests and you intend to emigrate. Another important aspect is really the return of contributed tax capital or share capital by a company. Now, if you return CTC or share capital by a company, it's not deemed to be a dividend, and it's thus not subject to dividends tax. So you often find scenarios where in one instance where somebody is subject to dividends tax, like an individual, there's rather a return of capital. Whereas if it's an amount paid by one company to another, it's a dividend, because it's actually exempt if one company in South Africa pays a dividend to another company. And that's not subject to dividends tax. To the extent that you pay a non-resident, that would also be subject to dividends tax, so the preference would be to return CTC. The general principle is that whenever you return CTC, you may not receive it in excess of an amount per share that is derived by dividing the total CTC by the number of shares. So you can only get a proportionate percentage. If there's 100 shares and 100 Rand of CTC, you can only get 1 Rand per shareholder and per share. From that perspective, you can't disproportionately distribute the CTC. And then some consultants argue that if you contribute a share premium by a particular shareholder, that's specifically linked to that shareholder and can be returned to that shareholder. And they've in fact then indicated that that's not the case. Shareholders within the same class must be treated from a practical perspective on the same basis. So the shares must be treated equally in the allocation of CTC. Obviously, there's also a benefit, because if you're an old shareholder and the CTC is very low and there's a new shareholder that introduces CTC, you can benefit from the new CTC that's introduced on a proportionate basis. So the converse is also applicable. Then if we maybe become a bit more technical, there's been certain commentators that interpreted the hybrid debt provisions, that is in certain circumstances, if you have debt and it's not repayable within 30 years, or it's not calculated with reference to a specific rate of interest, they indicated, and their argument was that it's only one-sided, and that this dividend, this interest that is recharacterized as a dividend, is then only deemed to be a dividend in the hands of the issuer and not a dividend in the hands of the lender, so to speak. So the argument was that there's a double whammy, in the sense that the issuer then can't deduct the amount because it's deemed to be a dividend, whereas the holder of the debt, or the lender, then still has to account for the interest. And then SARS has now indicated, or National Treasury, that it will become reciprocal. So to the extent that it's deemed to be a dividend declared by the issuer, the lender is then also deemed to have received the dividend as opposed to interest. Corporate reorganization rules, very technical. I'm not going to deal with that in detail, save to mention a number of issues. The one is really in the case of Section 42, the thorn about asset for share transactions, and that is really where the transferor or the seller transfers debt to the transferee in return for the issue of shares. So you have a seller or the transferor and the transferee, and where you transfer an asset together with debt to the transferee. Currently, the consequence is that the seller is deemed to have received an additional consideration equal to the amount of the debt assumed when one disposes of the share that is acquired. So you take the base cost of the shares, and then you actually have to add the debt as part of the proceeds in order to determine the tax that the seller has to pay with reference to the shares that he's received, in particular to the transferee. And then in order to combat the undermining, so to the extent that there's further corporate reorganization transactions and the like, you're still going to pay tax when you ultimately sell your shares in respect of a transaction that's not governed by the corporate reorganization rules. So you can't now enter into a new reorganization transaction and then argue, this deemed debt provision doesn't apply to me. Then Section 45 transactions. To a large extent, the argument is really, if you look at the current provisions, that there's a 6-year rule. You can't degroup within 6 years. So if you have a group, and that's really one of the reasons why the reliance upon Section 45 has declined, because for 6 years you actually need to retain that group, because if you do not, then there's a recoupment or a capital gain in the hands of the transferee of the assets. And this provision that is now going to be inserted really deals with the fact that any loan or outstanding purchase price that arises, to the extent that there's a degrouping, or ultimately after 6 years you're going to have at least a base cost, because otherwise the argument was that there was no base cost in relation to the loan that arose, because at this stage it's indicated that the loan has a base cost of 0. Unbundling transactions, at least there's some relief for taxpayers. Just maybe by way of background, what happened last year is that National Treasury then introduced the legislation to the effect that if you are a disqualified person, to a large extent a pension fund in South Africa or a non-resident, if you hold at least 5% of the equity shares in the unbundling company, that's now not the shares that you receive, but it's the shares in the company that unbundles the shares, then the unbundling provisions don't apply in relation to that. At least it's a proportionate argument, so to the extent that there are other shareholders that meet the requirements, the unbundling provisions and the rollover relief still applies. In this context, it's now going to propose that to the extent that you don't qualify for the rollover relief, at least you get a step up in the base cost, because the unbundling company is still going to pay the tax. So that's at least a benefit in the sense that you don't get the original base cost, you actually get a step up in the base cost to the extent that you don't qualify for the unbundling or the rollover relief. And then also with reference to other shares that you acquire, you're going to get your base cost or the purchase price that you've paid, as opposed to indicating that you just get all your shares in terms of the original transaction on original base cost. So at least there's some relief for taxpayers in relation to unbundlings, even though to the extent that you hold at least 5% of the equity shares in the unbundling company, disqualified person, you're not going to qualify. And if you look at the holding of shares on the JSE, pension funds, the GEP, FPIC, their holding to a large extent exceeds the 5%, also non-residents. At least there's not necessarily the reference that you count everybody together or add everybody together, but you treat it on an individual basis. You still have more than that 5% and you won't qualify for the rollover relief. So to a large extent, these provisions have been inserted so as to receive tax in relation to a shareholder that is non-resident or would not have paid tax. And that is really the rationale behind these amendments that were made from that perspective. As I said, no increase in the CGT rates or introduction of the wealth tax. I stand to correction because that was one of my predictions, because I thought that at least the CGT rates would be increased or there's an introduction of a wealth tax. Given the state that we are in, I think what has happened is that because of the 100 billion more or less that's over collected from the medium term budget that maybe saved us and save the day, because from that perspective, at least, we don't have those increases, but we must expect that there's going to be a significant scrutiny on our affairs with reference to all of these incentives that are going to be abolished, and I'm going to get to the interest and the assessed loss issues just now. So that's really the general trend. Yes, there may be some reduction or not an increase in rates, but we can expect SARS to come down hard on us with reference to our returns and to the extent that there are intricate structures. And we can see that especially in the context of, for instance, transfer pricing. There's a number of assessments out there, huge assessments, and it's quite time consuming from that perspective. Then at least one benefit, to the extent that you may qualify for an exemption of royalty tax or a reduction of the royalty tax. In the case of withholding taxes, you can now make the declaration on undertaking similar to interest and dividends, because that's been one of the issues. The one thing that we've been waiting for really is that introduction with reference to a regulated intermediary, especially in the context of interest, because there's always those issues and who should actually pay the taxes, but at this stage, there's nothing from that perspective. So at least there's one step in the right direction with reference to royalty withholding taxes, but I think it can maybe go a bit further from that perspective. A very contentious issue, the advanced tax ruling system will be reviewed, and also the voluntary disclosure program system will be reviewed. There's been a number of taxpayers and consultants that complained about the process pertaining to advanced tax ruling systems, the duration, maybe the interaction between the unit. I must say, from our perspective, we've had excellent service from that specific department. Yes, one can understand to the extent that they do not agree with you, but they consider the relevant submissions that you make. They actually revert to you, they come back to you, they interact with you. So I must say that's probably one of the best departments within SARS over the years. And yes, to the extent that it can be improved by all means, but I must say from our perspective, we've really had good service from them, and they've always, the service and the reaction, the reasoning is always of the highest quality. As I said, even though you don't agree with that, you understand what their thinking is, and on that basis, I must say they must be complimented. Yes, there is a review currently underway, but I must say there's not much that can be changed from our perspective. But yes, I think that's one of the big issues pertaining to the ATR department, and I think that's one of the recognitions that one should give to SARS pertaining to the way in which it has operated to date. Voluntary disclosure program, I must say, from that perspective, there's fewer and fewer taxpayers that actually make use of this. To a large extent, the reason is that the unit has adopted an approach to the effect that any disclosure to the unit must be voluntary. Now, there are provisions in the Tax Administration Act to the effect that to the extent that you're not under audit and you haven't been given notice of an audit, it may be voluntary. But the unit has now also adopted a different approach to the effect that to the extent that you may be on the SARS system with reference to, let's say, outstanding returns, if you make a submission to them, it's not voluntary. So to the extent that there's any record somewhere that there's an outstanding return in relation to the taxpayer, it is argued that it is not voluntary from that perspective. And I must say that's potentially contrary to the spirit of why the VDP system was introduced. So I hope that one considers the purpose of the VDP system, because I think there's numerous taxpayers that will make use of the VDP system, and additional taxes will be collected to the extent that it can be argued and the approach is adopted that a VDP application is voluntary to the extent that the taxpayer is not under audit. Because ironically, SARS has accepted the fact that if you're under audit for 1 year, let's say 2016, and you're not under audit for the subsequent year, 2017, any disclosure that you make in respect of the 2017 year will be voluntary. So that doesn't necessarily make sense to the extent that you argue that if you're on a system and there's an indication that you may have an outstanding return, it's not voluntary, and I think it has caused a number of taxpayers just to be outside the system. Obviously, it becomes more and more difficult, but I think to the extent that the decision and the policy decision is made to widen the VDP system, substantial more taxes will be received and generated by the unit, as it has already generated a substantial sum already. So I think the introduction of the VDP unit was really a significant step by SARS, and the fact that one has the VDP and a continuous VDP application that one can make as opposed to a specific VDP, that is really approachable, and I think one should definitely consider widening the policy such that a number of taxpayers can also make use of that, because at this stage they just keep quiet, because if they don't make use of the VDP system, then the problem is that they may have to pay penalties. And recently there's also been a case to the extent that if there is a successful VDP application and interest is imposed by the unit, you can separately make submissions for the remission of the interest. So it doesn't automatically follow that you have to pay interest pursuant to a successful VDP, because you can thereafter make submissions for SARS to consider whether or not interest should be imposed, whether it is outside your control, beyond your control, or in the earlier provisions, whether or not you acted reasonably. So there is now the possibility that interest may also be remitted to some extent, to the extent that, for instance, you submitted an objection, or to the extent that there's been an assessment. So that's also a step in the right direction, in the sense of interest just being imposed automatically from whenever the date may be, because at this stage, one of the issues pertaining to VDP is also that they can go back all the way, let's say 10 years or 20 years back, whereas in other cases one is bound by the prescription rules, which are either 3 years or 5 years. So one has the issue that to the extent that these issues can be addressed, because obviously a taxpayer that submits something that's 20 years old won't be able to afford anything to the extent that interest is imposed, because the so-called what we call in duplum rule, that is that interest cannot exceed the capital, doesn't apply to SARS. So the interest in a number of instances may well be more than the capital that you have to pay, and then you can't afford that. So there's a number of those type of issues that one may have to address with reference to the VDP system, even though, as I said, it does function well in the sense that you get feedback, even though there may have been a period with reference to 2 years ago or so with reference to the special VDP and so on, when one had to wait some time, but I think everybody has caught up at this stage. So I think from that perspective, both the ATR system and the VDP system are essential and integral parts of the administration of SARS, and it should be supported, and all the interaction and feedback should be given such that these two systems can be improved, and more certainty on the one hand is obtained from the ATR system and VDP, that there's more revenue collections, especially in the context of foreign income that may have been derived, and also individuals, companies, that it's thrown open for everybody to make use of the VDP system. Exchange control relaxations. We saw the relaxation pertaining to loop structures, and the Financial Surveillance Department of the Reserve Bank kept its word. Early in January, we had the relaxation where you can now have a loop structure, that is a South African resident can invest in a foreign entity that in turn invests back into a South African target, even more than 50%. But interesting what we see now, all these loop structures are still less than 50%, because the moment the South African entity holds more than 50% of the shares in a foreign entity, you have a controlled foreign company, and then you have to impute income in terms of Section 9D, and then it becomes too expensive. So from all that perspective, the interest is really 49% as opposed to the 40% that was allowed. And ironically, what has happened as well is that previously a loop structure from a South African Reserve Bank perspective included both shareholdings as well as loans and effective loans. And what has happened now is that also taxpayers make use of loans to fund foreign assets, let's say trusts and so on, and then you don't have a loop structure and the South African CFC provisions don't apply, and you just have an interest-free loan or whatever the consequences might be to the extent that the interest-free loan or interest-bearing loan is made to a foreign trust. So you don't have a true loop structure where you have a shielding, but the interests are still there. And on that basis, we may well expect some legislation in that regard as well. Dual listing, yes, we're going to see the new rules pertaining to dual listing, whether you've got your primary listing here, and there's always the argument whether you've got your branch register, is that the transfer when you transfer your branch register to your primary register? Those type of issues will have to be addressed. And then one important aspect is that the intention is really to promote South Africa as a financial hub, specifically pursuant to the African Continental Free Trade Agreement. So the intention really is that South Africa can do the asset management, the financial activities, and you don't necessarily have a permanent establishment or a place of effective management in South Africa. And I think that's also to be welcomed because ultimately that was always the intention, and that is one step in the right direction for South Africa to be the financial hub. Because if you look at our policies, our systems, the extent of the degree and excellence of our banks and financial entities, financial institutions, we can actually compete with anybody in the world, and it's quite important that we can and should promote South Africa as a financial hub. Ironically similar to what has happened to the UK and the EU, but similarly in a South African context, we need to be the financial hub for the continent, and we can to a large extent from that perspective. Financial sector levies. Unfortunately, we're going to see some levies to be tabled early in 2021. Revenue will fund the Prudential Authority and the Financial Sector Regulation Act, the Twin Peaks regulatory system. So we're going to see a number of levies there, and unfortunately that will increase the cost for doing business. But I think if you look at the way in which the authorities have acted to date and the interaction which I've seen, it can once again be recommended, and the introduction thereof, even though there's one or two smaller issues, can also be recommended, and that really emphasizes the fact that South Africa forms part of this worldwide and high recommendable financial sector services. Now, the one issue that I'd like to comment on is that what is going to be introduced, but not this year, relates to the limitation on interest deductions, and then also the limitation on claiming assessed losses. You will remember that last year there was the proposal that 80% of assessed losses will be carried forward, that you can use 20%. And especially in the COVID scenario, there are so many companies that have assessed losses that it's going to be quite inequitable to the extent that you can't utilize your assessed losses. So it was indicated that it will be postponed until 2022, and ironically that will also coincide with the reduction in the corporate tax rate. So from that perspective, the issue is that yes, we may see a reduction in the corporate tax rate, but we should expect a number of limitations, and the one will be a limitation on the use of assessed losses. Now, one of the things that one should consider in providing for a limitation in assessed losses is what about those type of provisions in the Income Tax Act that provide for incentives. That is, let's say you buy an aircraft and you can claim incentives, or a 12C allowance that you can claim, because to the extent that you can claim it and you don't generate income and there's assessed losses, it doesn't help you because you still have to pay the taxes. So those type of things will have to be taken into account. Also Section 20A of the Act dealing with individuals and impermissible trades, because it doesn't help you that the one provision says you can only carry it forward and the other one says you can't use it at all. So one will have to look at the interaction between those provisions in the Act that do allow for incentives and then the limitation of the assessed losses. The other issue obviously relates to more multinational entities, the MNEs, and the limitation on interest deductions, because it seems that it will be implemented. It seems that there's a 30% ability to claim the 30% of earnings, not necessarily tax EBITDA, in which you can claim the interest deduction. And it's going to be quite interesting to see how that's going to be implemented, because the latest is as well that it's not going to be limited to true interest, but it will also relate to related type of finance charges, maybe financial leases and all those type of things, which are not strictly speaking interest in terms of the Act. So that limitation on the ability to claim interest is going to be widened, and we're looking at the 30% threshold. It may well have a significant effect upon an even though smaller number of MNEs is going to have a significant effect on that, even though the intention then is for companies to rather capitalize subsidiaries as opposed to borrowing funds. Yes, they're going to maybe look at external funds as opposed to internal funds, but we'll have to see how that provision is looking like. But at least the benefit is that we're not going to see that in 2021, but only in 2022. So there will be more consultations pertaining to these issues, the use of assessed losses, and then also the limitation on the ability to claim interest, which at this stage will be set at 30% of earnings. So from that perspective, I think there's going to be a number of consultations and a number of taxpayers that will be upset, similar to the Section 12J type of submissions that will be made, and we'll have to see to what extent a compromise can be reached between these and then the intention to reduce the corporate tax rate to 27%, because those two and those three really go hand in hand. The corporate tax rate is not going to be reduced to the extent that these other provisions are not introduced. That is the assessed loss and the limitation on interest, and probably the widening of the tax base otherwise. So what we have, as I've indicated in the beginning, we have a broadening of the tax base, but if you look at the provisions, there's going to be a number of provisions and more stringent application of the provisions, even though there may be a reduction in the rate. At this stage, as I've said, it's personal, natural persons that are bearing the brunt of income tax. The question arises to what extent corporates can maybe add to the increase in the revenue collection, because that has gone down over the last 5 years, and the brunt has really been on individuals, which percentage has increased over the period. So that's really what we're looking at from a large perspective. Karushka, if you can just maybe come back to me, then I think from that perspective, I'm not sure whether there's any specific questions that we have. But I think we've tried to stick to the timelines and highlight the so-called nuclear bombs, because that's really what one is looking at from a large perspective. Because we need ETIs, for instance, but yes, there may be some abuse to some extent with reference to the training institution. So I think the major issues probably relate to 12J and the ETI, as opposed to some of the other issues. But to a large extent, that there's a number of issues that one will have to address. It's not so much the question that everything is relaxed and the revenue targets have been met. So thank you very much for attending. We really appreciate that. I said I'll come back to the Truman Show. The main character there, usually when he saw somebody in the morning, he said, "Good morning," and if I don't see you, good afternoon, good evening, and good night. Now it's a bit later in the day, so what I'll say is good afternoon, good evening, if I don't see you, good night. Thank you so much.